Awesome. All right. Shahryar, I hope I remember that pronunciation
Shahryar,
correctly.
yeah.
Okay, great. What I'm trying to see your camera view. You haven't come up. Oh, perfect. There you are. All right. I'll turn things over to you. Feel free to introduce yourself, Capital Pilot, and then just jump straight into the slides.
Cool. Thank you. Good morning, everyone. I'm Shahryar, and I am here to present to you how to become more investable from the perspective of investors. Just a few words about myself. I'm Chief Commercial Officer and Head of Funds at Capital Pilot, coming from the financial services background and have been with the business for the past 5 years, helping startups get more investable and also raise investments, also involved in setting up a fund myself. And so I'm coming from both the investor and the kind of startup perspective. Hopefully I can bring some of my insights and experience, as well as the insights from Capital Pilot business, who is in the business of rating and assessing startups. Just a few introductory words about Capital Pilot, and then we dive straight into the main contents of today. So Capital Pilot is the investability rating agency for startups. What does that mean? Our core product is a standardized and systematic rating system, combining human insights and data analytics to rate, assess, and evaluate startups across different criteria and data points, typical criteria that investors typically look for when they form investment decisions. And the output is a comprehensive assessment report, which provides rating and scores across various different data points, as well as some written commentary, bespoke analysis, and actionable feedback about your investor proposition. Now, how do we actually evaluate startups? Now, every investor has their own set of criteria. Some of those criteria, some of those investors attach certain weights to certain of those criteria, and some kind of view it as less applicable. However, there is a finite list of data or criteria that pretty much every investor agrees that is a key component of an investor proposition from a startup when it comes to evaluating companies. The way we look at it is as follows. We've broken down how an investor proposition is looked upon into four main categories: market, business opportunity, scalability, and executability. Different investors might call these sections differently, but one thing is common. Every investor looks at pretty much all these four criteria in different forms of formats. Now, what does those terms mean? Market is really about evaluating how attractive the company's target market is. And it usually references to the size of the market, the growth potential, how accessible that market is, how sustainable that market is, and also who are the competitors, what is the competition, amongst other factors, of course. A business opportunity really looks at the robustness of a company's business model by reviewing the strategy about how they attract customers, the value proposition of its products or services, attractiveness and sustainability of the pricing strategy, and also some other areas such as branding, messaging, and other related factors which contribute towards the business opportunity. Scalability, as the name suggests, is really about the scalability of a company's business model. There are different factors that contribute to that, including operational leverage, traction with customers, which are really signs of how scalable a company could potentially become, current and potential expected momentum in sales growth. Executability, on the other hand, is really about evaluating the skills, the experiences, the expertise that the core team and the wider team brings into the equation, the quality and completeness of the investor presentation, financial forecast, etc., etc. Now, having said that, having set the scene, as I mentioned, because Capital Pilot has been rating and assessing hundreds, if not thousands of companies, we have identified some of the most common areas of weakness when it comes to evaluating investor propositions. Now, I'll try to, in the next few slides, I'll try to go through some of those common areas of weakness, as well as other key components of what constitutes a good investor proposition, what makes you guys or your startups more investable. So hopefully, I mean, just to emphasize, these are all based on our data that we've been capturing through hundreds of assessments. So there is some concrete evidence that these are some of the recurring and most frequently seen areas that founders typically struggle with. You can see the headlines here: articulation of investor proposition, competitive landscape, proof of market approach strategy, presentation of traction, team, clarity and detail of financial model. Now, let's begin by going into some of these or all of these areas that I explained in some more detail. First of all, let's talk a little bit about the investor proposition. We often talk about a 90-second rule. What does that mean? Investors are time poor. VCs are time poor. They may not spend more than 90 seconds looking at your pitch decks or investor material. Now, it's really important to show them everything, all the key factors and criteria and information that they're looking for in a crisp presentation, and complement that with a strong proposition. Remember, it's not just about the presentation. It's about having a strong proposition and being able to articulate it as clearly as possible. We've seen many very nicely done, beautiful presentations without much kind of content, or which are not accompanied by a strong proposition. Yes, that nice presentation might make an initial impact, nice impression, but when investors go through that, if it's not complemented by what you're actually trying to do and how you're trying to solve a problem, and not providing any of the key information that investors are looking for, it's probably a wasted opportunity. At the same time, we've seen a lot of presentations or pitch decks, very strong propositions, but rather poorly done presentations. Now, that's not a deal breaker. In theory, investors shouldn't necessarily disregard that. However, in real life, it's very important to also, if you have a pretty strong proposition, just make a little effort to make the presentation look professional at least. We're not all designers. We don't necessarily need to create the most attractive and beautiful presentation, but at least make sure the information is presented concisely, clearly, and professionally. You are probably familiar with the following items. If you've done a pitch, if you've created a pitch deck before, I'm pretty sure you probably at some point during the course of this program, you'll be kind of going through how to creating pitch decks, or you will be, if you haven't, you will be creating your own pitch deck. But there are a number of headlines, if you like, or subjects that you need to have in your pitch deck. These are the key information that every investor looks at and uses to evaluate your investor proposition. Starting off with a problem, defining what the problem is and what the opportunity at hand is, what your solution and what your value proposition to address that problem is. Every pitch deck needs to talk about market sizing. You need to talk about your business model, how you're actually generating revenue, how does your business operate, what's your underlying magic, what's the magic sauce or the key competitive advantage of the business, what's your overall marketing and sales strategy, or in other words, your go-to-market strategy is. Traction is quite important. We'll come to some of these items in more details in a bit. Competition, who else exists in your market? Your team, one of the most important elements of a startup proposition, who the team is, and what skills and expertise or experiences does the team bring to the table, projections, milestones, and the ask. Now, one of the most one of the areas that has caused a lot of founders a lot of headache is market sizing. From experience, we've seen a lot of founders, especially first-time founders, struggle to get their heads around market sizing. Now, you might already be familiar with the terms TAM, SAM, SOM. If not, I mean, you can look at them in slides, but these are pretty much the standard terms that are used in the investment community to define the size of your market, starting off with SOM, which is short for serviceable obtainable market. This is really your immediate target audience, that percentage, or maybe let me start from top down just to explain what those means, might follow a more logical way. TAM, which is short for total addressable market. This is the total market for your product. This is the overall market, whether you're targeting local or global audiences, businesses, individuals, etc. That is the overall size of the market. But we know that it's almost impossible to attract and capture the whole of the market. But this is really there to scope the opportunity. Let's go one layer down. SAM, serviceable available market. It is that portion of the market that you can realistically acquire based on your business model. Again, those are the sub areas, kind of probably the more immediate geographies, if you like, or however you segment your market. These are more accessible to you. So this is a more realistic portion of the overall size of the market that you can eventually capture. And SOM, by the same token, serviceable obtainable market, is that percentage of SAM which you can realistically capture immediately. In other words, your immediate target audience. There are two ways to go about sizing your market, so-called bottom-up and top-down analysis. Many investors that we've come across kind of prefer to see bottom-up because it all starts off by you as founders defining who your customer is. In order to do a proper market sizing, first of all, you need to understand and identify who the actual target audience is. Once you do that, then you can effectively quantify them. Once you've identified the audience, the customer, and the markets, the geographies that you're trying to penetrate into, then you can quantify them. And once you do that, then your market size is simply the number of customers multiplied by the unit price of your product or service that you're offering. So that provides a monetary value, that attaches a monetary value to the market that you're trying to attract. Again, you can then expand on that. I mean, you can identify your immediate target audience, quantify that, then you can do your SAM, TAM, etc. And then that way you can shape your market sizing. The other approach, which is also common, is top-down. This really starts off by you identifying, working out what the overall size of the market is. In most cases, this is based on research or external research or third-party research that you've kind of used to quantify that the overall size of the market. And then you can apply a series of assumptions to break it down all the way through to quantifying your SAM and SOM to see what portion of that overall market you can realistically capture. So what's going to happen next? So far we've said in order to define market sizing, you need to identify your target customers, then quantify them. Now, what's going to happen next? Now that you've identified your target audience, you know where they are, and you know how many they are. Now it's time to devise plans and strategies in terms of how you plan to reach your target customer and capture your market share. Again, this is really the go-to-market strategy can be very specific to different business models. Different companies might come up with different plans. It can range from depending on who your audience are and where they can be found. You can make use of certain digital means, social media. You can make use of influencers. You can do roadshows, conferences, direct to customers, use intermediaries, build partnerships. So again, I'm not necessarily going to go through that because that's very specific to each business model, but it's really important to come up with a comprehensive plan of action in terms of how you are actually going to acquire those customers that you have clearly identified in those markets or segments of the market that you've identified. It's really about looking at the graph chart, who the target audience is, what product or service you're offering. It's about brand positioning. It's about identifying where those target markets is, how the marketing and sales plan can help you achieve your goals, and timing is also quite important. So all of those overall will constitute your go-to-market strategy. Now, you might start to realize that we're following a pattern, is following a storyline. We've identified the clients, the customers, quantified them. We've devised a plan about how to reach out to them and how to acquire them. Now it's about validating and building some traction. Now, it's no good if you have a go-to-market strategy which does not result in you acquiring customers. Now, I mean, a lot of investors attach a lot of value to what we call traction. So traction is related to everything that we've just explained, because it's really the evidence of real or potential customers within the markets that you've identified. Now, let's go through that. Let's together see what actually that means. Ultimately, traction, the ideal form of traction that every investor wants to see is revenue, sales, profit. So that's the ultimate. So someone out there is able to pull out their credit card and pay for your services and products. That's the ultimate form of traction. However, we all know at different stages of your development as a startup, it may not be possible to generate revenue up until you reach a certain milestone. In fact, the majority of early stage startups, pre-seed, seed stage startups, they may not even have revenue, generate revenue, let alone recurring revenue. So what else can be looked as traction? Anything such as pre-orders, signups, registrations, letters of intent, anything that suggests there is a potential demand for your services can still be considered as traction, even in the absence of revenue. How about these? We've seen a lot of startups and founders who kind of mistakenly talk about awards they receive or the mentions they get in magazines or the pitching competitions that they attended or their well-known advisors on board as forms of traction. Now, let's clarify something. These are all great validations of credibility about your startup, but they don't necessarily translate into demand for your product or service. None of those that we mentioned actually practically translate into revenue or customers for your business. They help you. All of that could be very great and kind of influencing your ability to attract customers, but by themselves, they're not considered as traction. So let's make sure you don't confuse them. By all means, if you have any of those, you should be mentioning those in your investment material. You should be proud of those, but let's not confuse them with traction. The following bullet points, we've tried to kind of summarize how kind of traction, what source of traction is considered to be relevant depending on your stage of development. When we talk about traction for B2C early stage companies where there is no product or there's a prototype, anything such as signups or creation of a waiting list or pre-orders can be considered as a form of traction. When it comes to B2B companies at early stage, things such as letters of intent, for example, or expressions of interest or pre-orders could be considered as forms of traction. When it comes to businesses, app businesses, platforms, SaaS businesses, etc., a number of users, maybe freemium users, signups, waiting lists, etc., those can be considered as appropriate forms of traction. And for all later stage businesses, revenue and even better profit will be the ultimate form of traction that investors expect to see. Now, the next area that I would like to discuss is about the team. You probably have heard, or you will hear in a lot of your conversations with investors, how important the team is. Now, what is it that investors look for in a team? First of all, it's about completeness of team expertise. There are a number of areas of expertise that every company needs to show and investors typically need to see evidence of. Domain expertise is one. You need to have a domain expert in your team, someone who understands that domain and can be considered an expert. Technical expertise. I mean, in tech businesses, that's the tech team, but in general, more general, this is the expertise which helps you build your service or product, that the technical aspect of the proposition. Also, sales and growth expertise. At the end of the day, for having a startup, in a startup, you need to be good at sales and growing your business. Fundraising itself is a sales activity. And also when it comes to offering your services and products, you need to have that kind of sales expertise to grow the business. All of these it's also completely understandable if at very early stage you don't have all of those expertise in your core team. So what do you need to do then? First of all, you need to show some competitive edge for the team. So the more you have, if you have those if your core team covers those areas of expertise, then you should be talking about them. You should show the investors that you have those skills in your team. If not, it's absolutely fine. You can acknowledge the gaps in knowledge in your skill set, but also have plans about how you're planning to build feature team. After all, once you do your fundraising, a good proportion of every fundraising will go into hiring. So as long as you're aware of what areas of expertise or skills you're missing, and you have a plan in place to acquire those skills, that's also completely understandable. No one expects you to have every single individual, all of those expertise. In many cases, at early stage, the founder or co-founders or the core team might all bring some parts of those expertise themselves. But over time, when the kind of roles and responsibilities are clear, team grows, then each of those fall into its own department or division, if you like. But it's important to show evidence of that in your investment material. These are some hints and tips that I can quickly share with you. When it comes to presenting your team in a pitch deck, make sure the job description is clear. Make sure if there is any prior relevant experience is clearly mentioned. And make sure you include all of your core team members and advisors. And by the way, having advisors on board is another way to get around having kind of addressing lack of expertise in your team. If you don't have a certain skill set in your core team, consider bringing on board advisors who can bring that experience to the table until you're able to hire someone full-time for your business to do that. Also, make sure that your LinkedIn and website information are all up to date and consistent with what you're showing in your pitch deck. Most investors verify and check your LinkedIn profiles and websites as well. And sometimes if they see some inconsistencies, which might be for a good reason, that might raise a red flag. So make sure if you're that all of your channels are aligned and consistent when it comes to presenting your team. Now, the final section that I would like to talk a little bit about, which probably requires a whole session by itself, is about financial models. This is a headache for a lot of founders. So if you've been struggling with building a financial model, don't worry, you're not alone. We've seen hundreds of founders who've had the same issue. Founders want to focus on their business, build their products or services, go to the market and grow the business. So why on earth do they need to build a financial model? Now, a financial model is not by any means the most important factor in the eyes of investors. However, this complements the investor pitch deck by providing investors with an overview or with a view of how in control you are for the business, how thoroughly you've thought about different components of the business and how you're planning to grow the business. In other words, have you considered have you been using sensible and credible assumptions about different aspects of your business when it comes to building revenue projections, for example, or cash flow projections or cost breakdown? Now, every financial model, just to keep it very simple, needs to show revenue buildup and needs to show cost and expenses buildup. The good news is that the cost and expense buildup they're a relative kind of a finite list of items, very standard list of items that pretty much every business incurs as an expense or a cost. So as long as you know them, you're aware of them, you identify them, and you have a good view of how those expenses are building up, then you're probably fine by applying certain sensible assumptions. Revenue buildup can be specific to different businesses, depending on your business model and revenue model. There might be different revenue streams. So it's quite important for you as founders to be aware of how those revenues are generated and how you're planning to grow them over time. And of course, cash flow projections is also another aspect of it, which a lot of investors attach a lot of value to. It's about how you're planning to expand, to use your cash, at which point in time you're injecting cash, and how that cash is spent over time and utilized. Most investors require to see at least a 3-year forecast. Many of them prefer 5 years. But remember, these are all projections, and we all know those projections can change overnight with any internal or external factor. So the key thing that I want to emphasize on is the sensibility and credibility of the assumptions that underlie those projections. Now, we can spend a whole session, as I said, about how to build a financial model, how to go about it. But if there is one point that I would like you to take away from this, is the importance of assumptions. In order to come up with those credible and sensible assumptions, you need to think very carefully about your business model, your market dynamics, and how you're planning to grow the business. That's actually a very useful exercise. Believe me, when you start thinking about when you're forced to think about those aspects, it helps you kind of understand better and more clearly how you're planning to grow the business and what potential obstacles you might find. So it's actually worth the time and effort to go through this exercise, build those assumptions out, create those revenue buildups, cost breakdown, cash flow projections for at least 3 years, and see where that leads. Effectively, that will show you how realistic your growth projections or your aspirations about building a business will be once you do that. Now, let me finish this section by saying that you shouldn't forget investors in your presentation as a final tip. Remember, the investor is looking for a business, not only an idea or solution. As founders, it's really easy to get into that trap, to come up with the most amazing product and create a pitch deck which talks a lot about the product, but not really going through the business size of it. At the end of the day, investors want to make financial returns. Of course, there are investors who invest for their passion. There are impact investors as well who are looking to get some impact returns, to see the impact of your business on the society or environment as well. But most investors are looking for a business that gives them the return that they're hoping for. So they're looking for a business, not necessarily a nice idea and solution. With that in mind, I'm going to end this presentation. We have a load of free resources on our website, Capital Pilot, about building pitch decks, financial models, and any other aspects of fundraising. So feel free to have a look around. There is a newsletter that you're welcome to join if you want to receive those content. But also, we've agreed with Hotbit to provide you all with a discounted assessment of your investability, if you like. So please get in touch with Purdy and MA after the session. They'll let you know about the offer. Effectively, through that, you'll be able to receive a comprehensive 24-page assessment report, which looks at all of the areas that I initially kind of touched upon early on in the presentation, provides you with ratings and scores across those areas, and also provides you with some qualitative analysis and actionable feedback to help you get into your best possible shape for your fundraising. You can reach out to myself, Shahryar at Capital Pilot, and my colleague Wenwen, who's the account manager at wenwen@capitalpilot.com. If you have any specific questions, we're more than happy to help you. So I'll leave it at that, and I'm now happy and open to answer any questions you might have.
Thank you so much. I'm so impressed how much information you managed to cover in 35 minutes. So bravo. I had a few questions to start out with, but honestly, the chat has been filled with so many questions. I want to try to get through as many as possible from our founders. So we will, as the past two sessions, if anyone wants to ask a question live, go ahead and raise your hand. We'll call on you that way. I'm going to start off with a question from Eddie in the chat, and then we'll go back and forth between live questions and chat questions. Okay, first question, what is operational leverage?
Sure, good question. So operational leverage is about how your revenues grow in comparison to your cost breakdown. So if your revenue grow without you needing to increase your cost base, that means that you have operational leverage. Most kind of software type businesses have a high operational leverage, because in order to increase revenue or increase your customer base, you don't necessarily need to increase your cost base. However, when it comes to physical products, in order to build more revenue, you probably need to produce more goods, which cost you. So the operational leverage is slightly kind of decreases. So operational leverage is nothing more than how your revenue grows compared to your cost effectively.
So like it's basically synonymous with products with good margins.
Yes, it's about economies of scale and having creating margins without necessarily increasing your cost base.
Awesome. Okay, Andre, you're up first. Oh, you're on mute.
Sorry, I clicked the wrong button. Hi, it's okay. I have a question about the team page. So obviously everybody says the team page is the most important. I hear that a lot, and I understand why. I have a question. Like on paper, I think me and my co-founder probably don't look like great as compared to many other people, because we never really did anything in public. Like I think we are the people, we get things done. And like me, myself, I'm a software engineer. I work for like over 10 years, but everything I done was only like working for someone. I don't have anything to show in public, like, those are my skills. And about my co-founder, I guess it's probably even worse, a bit worse situation, because he doesn't have a degree, but he's like get things done person. He's a salesperson for conventional business. So how do we make ourselves look good on the team page so investor is not put off?
Sure. So first of all, do not underestimate your skill set. I mean, you surely two of you have a range of skills that will probably help you. I mean, without necessarily knowing what your business is or what you're planning to do. So if you're experts in the technical aspect of the business, or you consider domain experts, just make sure to talk about those aspects of your experience or expertise that is relevant to the business. And also, as I said, it's absolutely fine if you don't necessarily have all of those kind of skills initially in your team once you first form the business. But as long as you're aware of it there are various different ways to go about it. First of all, consider bringing on board maybe another co-founder if you really think that you're lacking experience in, say, the market-facing role, sales, growth, or those kind of expertise. Consider maybe bringing on another co-founder, or consider bringing on board advisors who can provide you with that sort of skills initially. Or at the very least, when it comes to planning for your future hires or building a team, just acknowledge the fact that you're missing these kind of skill set, and you have a concrete plan in place to get those type of talents into the team. Again, it really depends on what you're doing and what investors you're looking for. There are investors who are happy to take the risk at early stage without necessarily a full team to be formed, but there are all other investors who might question about the availability of those expertise and skills in your team. As long as you have a reasonable answer and a plan to address that, I think you should be fine. But whatever your kind of background is, just be proud of it. Make sure, just come up to kind of highlight those aspects of your experience which are relevant to your business, and put that on your presentation and any other sources of information that you have, and have a plan in place to address the other gaps in skills. That's.
Oh yeah, maybe.
Hey, sorry, Andre.
Like...
Andre, I'm gonna jump in just because we have a lot of questions to get.
Of course. Oh yes.
Yes. But
Thank you.
that was a good one. Okay, I'm going to take two questions from the chat. They're both about the go-to-market strategy. I'm just going to ask them both in a row so we can get through more. The first one is from Julian, and it says, for go-to-market strategy, would it help to use the business model canvas approach? And then Ove's question is, how long does the go-to-market strategy need to cover, 12 months or 5 years?
Well, it depends. I mean, in terms of the format, I mean, there is no one fits all formula for this. So feel free to kind of be creative about that. In terms of how much details you need and how much in future you need to look for that. I mean, it's very unrealistic that you will have the same go-to-market strategy in 5 years' time, because as startups, things could change. So as long as you have a concrete plan for the next year or so to acquire your immediate target audience that you've defined as your SOM in your market sizing, which typically should happen within a year or two of the business inception, that's probably good enough. In terms of how much details, I mean, first of all, as long as you have a single slide dedicated to that in your pitch deck, that's fine. In terms of details, the more details you can provide about the actual go-to-market strategy, the better. A lot of founders just leave it at very high level, saying that we are going to use social media or build partnerships, but really investors want to see what social media, why do you, for example, as an example, if you're using social media, why is that? Is there a particular plan? Are you using paid advertisement or direct? Are you reaching out directly to your target audience? Is social media the best platform to acquire your customers? If you're building partnerships, how are you going about that? So providing a little bit of flavor to what that plan actually is. And if you have already validated some of those plans and approaches, if you've taken some steps that have resulted in some positive outcomes, make sure to talk about those as well. But more details, better. Let's maybe focus on the shorter term, have a view about the longer term approach as well. But it's very unlikely that you will, until you acquire the first customers, it's very relatively unrealistic to have a plan for in 5 years' time, if you like.
Awesome. Okay, Mary Jo.
Well, thank you so much. That was really useful. I just really wanted to recommend your assessment process. We've done it, in fact, twice, only because we were lucky to get a voucher for the second time round, and unfortunately just missed the fund. So I've got two questions, really. The first one is, will there be a fund? Is there a fund in process? If so, when might that be on the horizon? Because I know a lot of companies that really benefited from that. And my second point is, well, it's not really a question. What's I think so valuable, and the reason why I'd recommend anyone doing the assessment here if they haven't done it, is that it can give you some real confidence in some of the factors that you have got, but also gives you some really useful, supportive advice on what's missing. And it's done in quite a systemic way, which I think is often missing, because if I had 50p for every time I've talked about pitch decks and different ways of doing it, I would be rich by now and wouldn't need to continue. So we all know that everyone is going to have a personal response to a pitch deck, but if you want to get some sound systemic advice on making yours better and feel confident in what you've got and what's missing, then I would recommend doing this assessment.
Thank you, Mary-Jo, for the nice words. Yes, as you said, I mean, this is really about providing you with bias-free, independent advice from the perspective of investors, providing you with some quantitative and qualitative kind of information about how to build confidence and improve your proposition. In terms of your question about the fund, just for everyone's information, last year we launched a fund on the back of the rating, which was making automated investments purely based on the rating. So if the rating was above a certain threshold, companies qualified to receive £50,000 of investments. That fund is currently closed. We have plans to launch funds in the future. I don't have any information about the timelines, but we will let all of our communities and partners know as soon as there is information about the next fund. In the meantime, if you're interested in the assessment, as I said, we're providing you with a special discount for this group of founders. So please feel free to come and apply and get your assessment report.
All right. Juan, take a question from you.
Okay, thank you very much. Thank you for all the information, very useful. So one question I have is, for example, if my industry is so broad and I will have a massive market, I heard that the more specific that we get, the more that we can address the needs of a smaller and a specific industry. So what will be the top 5 statistics in terms of market research and the market opportunity that can demonstrate a significant opportunity? So that's basically
what are the top 5?
question.
Sorry, I didn't get the top 5.
Yeah, well, the top 5 statistics or like numbers that investors want to see, you know, in a presentation, because you end up with a lot of information after you do your market research, and I just wanted to know what is more appealing for them and what is like the most important things. So yeah.
So as this slide shows, probably the most important numbers that investors want to see are actually your TAM, SAM, SOM numbers. Now, I understand a lot of, we've seen a lot of founders such as yourself who are dealing with huge markets. So in order to come up with these numbers, you need to become more specific. Yes, that overall market size could be the TAM could be the overall size of a market. But the more, as you go down the layers, you need to be more specific. So what is the actual portion of your overall market which you can attract immediately? Who is your immediate target audience in that large market? So as long as you can be very specific about who you're targeting first and how many of them exist, and then maybe go a layer up, that's probably enough. As long as you're showing your TAM, SAM, SOM, and you're able to substantiate those numbers, whether by showing research, external research, or your own calculations when it comes to a bottom-up approach, the number of customers, unit price, etc. That's probably all investors want to see. They want to see how credible the market sizing is and how actually large the market is in terms of scoping the opportunity for them.
All right. Okay, gonna take a question from Frederick. How do you calculate and show the market size for a subscription-based business or SaaS company? Is it the number of subscribers per month or per year? Frederick, do you want to come off mute and add any other context to that question?
Yeah, first of all, thanks for brilliant presentation. Very, very useful. I'm just not sure, like, how do you express the market size? Like, is it the revenue you're hoping to get? Is it the number of people? Is it like, if you have a subscription business, is it like how much revenue can you make per subscription cycle, or do you calculate it based on the length of a year, or like how do you what is the unit, like what is how do you express it?
Sure. So ideally, you should kind of attach some monetary value to your market sizing. However, I mean, everything that you mentioned are relevant as long as you can show them clearly in your presentation. It could be your market size. Now, when it comes to SaaS businesses, first of all, in order to come up with your market sizing, you surely have identified a type of organizations or businesses who would be your clients or customers. Now, as a first step, how many of those, and probably you have probably identified the different geographies that those businesses operate in or exist in. In order to do that, maybe you can segment those into by identifying the number of those businesses, clients of yours who will be subscribing to you. Theoretically, you can identify the numbers in your immediate target model. Let's assume that you're targeting certain types of businesses in the UK as your initial target audience, and then you can expand into Europe and globally. In the UK, how many of those businesses that fit the criteria, that the profile of your target audience exist in that market? At the same time, you probably have a price of your service, software, an annual price or monthly price, however you want to look at it. Usually it's looked at upon annually, and simply by it's an estimate at the end of the day, by showing how many of those businesses you can realistically acquire, what would be the associated revenue that you can potentially generate from that share of market, and show that in your market sizing. That could be as simple as that. It shouldn't be anything complicated. Let's not overcomplicate things, as long as you're very clear about who you're targeting and how much revenue they can help you generate. How many of those clients exist in the market? That should do the job.
Awesome.
Okay, brilliant. Thank you.
Julian, you asked a great question. I was just about to read it out from the chat, but I see you have your hand raised. So why don't you go ahead and ask it live?
Thanks very much. Great material. Thanks. Yeah, I've got years of experience of program and project management, and that includes ducking and weaving a lot. You know, the difference between the plan and reality, and risk management, and all the rest of it. And it disturbs me when, you know, in this kind of situation, we're asked to produce a 3 to 5 year finance forecast, which has a huge number of assumptions based into it and all the rest of it. And my question was about whether it helps to actually say we recognize that reality will kick in fairly rapidly, and also there will be some alternative ways of climbing the mountain. I've been told by other sources and other advisors that implies indecisiveness, whereas to me it implies, you know, just pragmatic and can do kind of approach to making difficult things happen. I am in a quandary.
Sure. Great question, actually. If you ask me if there are other ways other than showing a 3 to 5 year financial forecast to show that, yes, but unfortunately in this market, investors still look at the financial model. But as I mentioned in the presentation, this is not the most important factor. This really, I mean, how investors look at a financial model is they just want to get a sense about how realistic and sensible the assumptions that you've considered are. What those numbers look in 3 to 5 years could be irrelevant, because anything can change overnight. COVID hits, and all of a sudden your 5 year forecast is doesn't make any sense. So things out of there are things out of founders' control. However, this is something that investors still want to see, complementing the pitch deck. As long as I said, you are showing them that you've thought about the assumptions, you are clear about the underlying assumptions, you show them clearly, and you have a relatively reasonable view of how your revenue is expected to grow vis-a-vis your costs and the cash flow, etc. You don't necessarily need to use the most sophisticated and complicated spreadsheet. It shouldn't necessarily be a consolidated view on an annual basis. Every investor probably wants to see monthly projections anyways. But we've seen so many financial models who have tens of tabs and go into so much details. Great. If you can, if you have that, if you can produce that, great. But as long as you have the main material that investors are interested in, that should do the job.
All right.
Yeah, sorry, it's not about having
sorry.
the model up top.
Hey,
it's
Julian.
about whether the model has.
Julian, sorry, I'm gonna jump in
scenarios.
just because we only have 5 minutes. Sorry, hopefully we'll be able to get your the rest of your question in another session. Okay, gonna take a question from Roman in the chat. It's a question about financial projections. What if we do not have a physical product, hence no units sold, but rather rely heavily on ads and referrals that vary greatly depending on the number of users we can attract to the platform? In that case, should we just assume that we will have steady growth in a number of users for that forecast?
Yes, well, at the end of the day, I mean, this can be very, it depends on your business model. Not, as you said, not every business might have a physical unit, or there might be different source of revenue. But however, for every potential customer of yours, you can probably estimate an average kind of price or revenue associated with that. So again, it really goes down to how you define your market and the assumptions that we talked about. As long as you're very clear about your assumptions, you're applying sensible assumptions in order to build your market sizing and also financial forecasts, that should be fine. There is no, as I said, one fits all formula. Key thing here is showing those assumptions as clearly and as concisely as possible in your material.
Right.
Thank you so much.
Eddie.
Hey, yeah, sorry, I was just thinking about the sort of advisors or team slide. And if you bring in people on, like I've got some people who have agreed to be co-founders if I get investment. So I put them as like co-founders on the deck, but they're sort of acting to help at the moment with sort of an advisor sort of position, sort of just like a few hours a week. So it's not really sort of co-founder level equity split. And I'm just thinking about how you think about investing, how you think about how much to give them, because I don't want them to stop helping in the current situation, but also they're really more advisors. I just want to know how to sort of approach that discussion with them until they're ready to go full time, as I am at the moment.
Well, again, I may not be the best person to comment on that. It really, at the end of the day, it depends on how you're planning to grow the business, how much equity you're willing to give away, and whether or not you have plans in place to hire people, when your next fundraising is, who you're planning to hire. So it's really difficult to kind of tell you what the best way forward is without knowing too much context about the business. However, the point of what I was trying to say is that in the eyes of investors, and by the way, we're trying to put ourselves in the shoes of investors, see how they perceive, how they look at your business proposition. In some cases, having some advisors who can, even on paper, bring some value to the table in terms of expertise or opening up channels for you, for example, that could help. Yes, some advisors might be more hands-on, more involved. They might be getting some equity for the business as well. Some of them might be just doing pro bono work and less hands-on. But again, depending on the situation of the business, as long as there's some value that they can bring to the table that you can make investors more comfortable about having someone in the team who can kind of provide that level of expertise to a certain extent, that's great. Ultimately, if you can bring everyone into the core team and hire people, then great, but conscious of the fact that not many startups are in a position until they do a significant fundraising to do that. So again, it really depends on your situations, but it's more about showing whether or not you have the overall skill set or the expertise that investors want to see.
All right. Okay, we only have 1 minute left. Ramiro and Daniel, I'm gonna try to, why don't you both ask your questions and then we'll try to get through both answers, but please keep it as short as possible.
Thank you very much for the presentation and for hosting again. I have a quick question, just for a change. In one of the first slides, you on the things that should be covered on the pitch deck, you mentioned underlying magic. Can you expand, and what can we expect as an actual impact from this underlying magic?
Sure. Underlying magic is effectively what differentiates you effectively from the rest of the market. It could be about your technology, something unique about your technology, something unique about your client proposition, or something that sets you apart from the rest of the market. That's the underlying magic that no one else, theoretically, in market can do. Your unique selling point, if you like. That's kind of what I meant.
Great. And then Daniel, let's do yours as a final question.
Thank you. Morning, everyone. On the financial model, I'd be interested to understand how that might impact one's valuation and how best to use that to, maximize or convince the valuation.
It probably, investors might take different views about this. It doesn't necessarily have an impact on your valuation at that stage and that in your current fundraising, because your current valuation at which you're trying to fundraise probably, yes, at the end of it, it's about scoping the opportunity and how, obviously you want the best deal for your business, so you want to set the valuation higher, investors want to say lower, so it's a kind of a negotiation game. However, if you have a very solid financial projections based on very strong assumptions, assumptions that show that you are, let's say, likely based on those assumptions to hit a certain kind of target milestone, you're able to grow the business significantly, and you can justify, let's say, a 10x uplift in your revenues, for example, which kind of can show, if your investors can buy into that, there are concrete evidence to support that, then that can support your valuation. In most cases, valuation is down to negotiations between investors and founders more than anything else. Anything else you provide in your pitch deck and financial model to support that you have a strong business and you have a strong use case could give you the upper hand in the negotiations, but at the end of the day, the entity who has the money, the investor, probably has a lot of bargaining power. So it comes down to how you can negotiate and come up with the most appropriate valuation at that point in time.
Okay, thank you.
Right. Thank you so much, Shahryar. That was so useful. We've got a few questions in the chat of whether or not this deck will be shared. Is it possible that we could email this to founders?
Sure. I'll email it to you afterwards so you can distribute with the team. No problem. Happy to.
Perfect. Thank you so much. And just a reminder, everyone, we do have that 20% discount code. We'll email that as well in the follow-up. So thank you so much. We'll say goodbye to Shahryar now, but founders, stick around. We have another session. Everyone wave goodbye. Say thank you.
Thank you. It was good to be with you guys. Best of luck for the rest of the program.
Great session.
Thank you.
Thanks so much.
Thank you.